When most people are looking to buy property, they research every little thing except taxes and structuring. And then when tax time comes around, this oversight ends up costing them thousands of dollars. I'm Davie, I'm a chartered accountant, and I help business owners and property investors maximize their investment returns and minimize their taxes. In this deep dive, I break down how to know which investment structure is right for you, how to avoid tax pitfalls that catch most investors off guard, and what the most effective tax saving strategies are for each structure. Let's dive right in. These are the different taxes that you need to deal with when it comes to property. The first one is the most obvious one, income tax and capital gains tax. They're both pretty much linked. I kept it separate because when you buy a property and sell property, people only really think about this one. The accountants always think about this. The not the business owners, but the investors always think about this one here, income tax. So investors always think about income tax because they always think about negative gearing. They hear it everywhere in the world. They hear it on YouTube, they hear it online. And it's all about negative gearing. How do I minimize my tax? You negative gear. You buy property that negative gear, then you get tax back, and then you can buy more property and invest. And then the accountants, they come in and go, well, you should buy property in your personal name or in a trust because you get a 50% discount. That's why they always say. But then they always forget about these three different taxes here. Some of them don't apply to you, which is GST most of the time. But then land tax is something that always impacts you. So income tax is basically tax on your profits, basically. So the tax rate for income tax can go from 0% all the way to 47%, depending on your personal taxes. If you're that's if you're an individual. Okay, if you're a company or a trust, then things change a bit, and your tax rates can be like 25 to 30%. If you're a trust, then it depends on who you distribute the profits to. So, and then superannuation, 15% or 0%. So it depends on what you're making and then the entity that has the tax rate. So most investors are either individuals and trust, but there is actually something called a bucket company that I'm a big fan of, just so you know. Okay, capital gains tax, it's basically tax on your profit as well, but not on the income and expenses that you're earning every year on the rental property or the investment property. It's actually on the buying and selling of the property. So this happens, maybe once every 5 to 10 years when you own a property. And usually for your individual, you get a 50% discount. So yes, you still have the same tax rates as what I said before, 25 to 30% for a company, 47% for individual. And for SMSF, it's a bit higher. It's lower, for a super fund. And if you're not sure what a super fund is, that's fine. There's a lot of videos online you can watch and videos I've released about it too. So usually you get a 50% discount if you own the property for more than 12 months. But for a company, you don't actually get it. It's not applicable, basically. So a lot of accountants are against buying property in a company. Well, not against, they just completely don't even think about it. They always think about a trust. And the reason being is because it still gives you the 50% discount. And so that's why they always think about trust and individuals or SMSFs for accountants. But usually companies are quite effective if you've got a cash flow generating property. A cash flow generating property means that you fix the tax rate at 25 to 30% and you get to retain the profits that you make and have a fully franked dividend. We'll go into more detail about that in the structuring. But basically, these are different taxes that you deal with that most people know about. And then land tax is the one that I consider the forgotten tax. So basically, income tax and capital gains tax is a federal tax. The whole of Australia, the Australian government charges that tax using the Australian Taxation Office. Land tax, on the other hand, is a state tax. It's charged by the state governments. So New South Wales, Victoria, Queensland, Western Australia, they're the ones that charge this tax. And so it's kind of like counter rates. If you own property before, you have to pay counter rates as well. And counter rates is just to run the council, right? The local government. Whereas the state government also wants to charge a certain amount of taxes as well, just to run the state government. So therefore, this one here varies. It depends on every state. It's very confusing. So you have to look at your state that you're buying in, and not where you live, but the property that you're buying, and you got to check that tax rate. And this one here is a killer, because if you get it wrong, you're going to be charged that amount every single year, and you have to pay it until the day that you sell. And some people just go, well, I've never heard of land tax and I've been an investor for a very long time. It's because the state government's a bit slow, but when you do decide to sell, they'll hit you for 4 or 5 years worth of land tax all at once. I've had a friend who used to mention to me that, hey, Davie, I've never paid land tax. Why is that? And I said to her, it's like your income taxes. You have to lodge your own income tax return. If you haven't lodged your income tax return, then the state government will eventually one day catch up, but they're just behind. Okay, so GST, you most likely can ignore this if you're not buying commercial properties or you're not buying a property to knock down and rebuild. It's something that you need to be careful of because a lot of people don't account for the 10% tax that you need to pay when you earn income from commercial properties or when you buy a piece of land and then you knock it down and rebuild. This is quite dangerous because the tax rate could be quite high and you just never accounted for that 10%. So just be careful with this. Just know that if you're looking at commercial properties and property development, speak to an accountant straight away. The last one is stamp duty. You guys all know that, but you might not know that it's actually a tax that's levied by the state government, and it's a 2 to 5%. And the reason why I bring this up is because sometimes during your investment journey, you might transfer a property that you own to one of your kids or to a super fund. And so therefore, I just bring this up because you might pay stamp duty twice. So it's actually important just to know the different taxes. Cool. And so when I do the structuring and I give you guys advice on structuring, I look at all these different taxes. Most accountants, like I said, look at capital gains tax, and that's it. Individuals also look at income tax, but then they forget about these last 3 different taxes. So it's important to even just consider it, because there are some ways to minimize the land tax, and there's some ways to get around GST so you don't have to pay it. And stamp duty, maybe if you're planning to transfer it in the future, then it might be a better structure for you instead of putting in your personal name. So there are 4 different structures that I usually recommend for investing. So individuals, which is this one here, it's cheap, it's simple. You can claim negative gearing in your personal name. So negative gearing is basically you're making income in your personal name through wages, like PAYG income, and you're paying taxes. And you're usually paying a tax rate of anywhere between 0 to 47%, right? And if you're making that money and you're paying like a high amount of income, say, so you're earning like about $200,000, your tax rate's at 47%. So if you make a loss in your rental property in terms of like the rental income minus the rental expenses, then you can offset the $10,000 loss, for example, against your 200K income and pay and save about 47% in taxes. That's where you get a tax refund at the end of the financial year when you lodge your tax return. A lot of people, high income earners, look at this strategy to invest using negative gearing, so they can get a bit more back from their taxes and pay less taxes. But the issue about doing this is because they're thinking about the short-term view of a property being negative geared. But in the long run, say 5 to 10 years later, when your rental income keeps increasing and your loan amount drops, what happens is that your property becomes positively geared. And because you're say a doctor or IT or a lawyer that's working in that field for 10 to 15 years, the result is you're going to be making, your property is going to turn into positively geared, and you're going to be taxed at 47% tax. And a lot of people don't like think about this, but then they come to Davie or come to an accountant and go, well, what do I do now? Like, I'm getting double taxed because I'm getting taxed, or I'm not getting double taxed, but I'm getting taxed at 47% in my salary because my salary is higher now. And also I'm getting taxed 47% of my rental income. Like, what's the point? Like, how do I even structure this and move my property investments out elsewhere? And I said, well, the result is you got to pay double stamp duty to transfer it out, and you got to transfer it to a bucket company. So sometimes when you're doing the calculation of buying a property, you need to look at the future goals and the long-term goals of like what's going to happen to this property. Is it going to be positively geared in 5-10 years time? If so, then maybe you should just bite the bullet in the short run, pay 30% tax, lose the CGT discount because a company doesn't have a CGT discount, but then like it's better just to put it in the company in the first place. Okay, so the great thing about an individual as buying in a property in an individual is the fact that you get main residence exemption. So main residence exemption is that if you have a home, and yes, sure, it's your investment property, but you lived in it for more than you lived in it in one period of your time, you have 6 years to still elect that property as your main residence. So you can use the 6-year rule to exempt that property from tax. So if you sell it within 6 years of moving out and you don't have any other homes or property that you live in, that's yours, then you can still get that tax, property tax free. And that's really powerful. When you buy a property in a bucket company or family trust or SMSF, you lose the ability to say it's your home for tax purposes. So a lot of people, when they come to me and they don't even have a property and they want to buy a property for investment purposes, but they want to put it straight into a family trust, my question I ask them is, are you planning to live in it? And sometimes the answer is yes. If that answer is yes, then they lose the ability to claim main residence exemption if they bought it in a family trust. So you got to be careful. If the property is something that you're planning to live in, then most likely it's a good idea for you to buy in your personal name. Cool. All right. So that's a personal. Bucket company is very different. There's a lot of asset protection, people say. So what it means is that because you're buying property in a separate entity, that means that it's not owned by you personally. So therefore, it's actually quite protected because if you get sued personally, they're going after your personal assets and your bucket company might not be owned by you. And the property that the bucket company owns is also not owned by you. So therefore, like there's a bit of separation and protection. Also the other way around, like if something happens in the bucket company where for example, the tenant sues the landowner, which is the bucket company, they can't go after you personally because it's all in the company. So that's what asset protection is. But the downfall of a bucket company is there's no CGT discount. So that 50% discount that you usually get, you don't get it. You don't get it in a bucket company. It's just not applicable. The government thinks that the tax rate of a company is 25 to 30%. It's low enough. So we don't give you the CGT discount. In some states, there is land tax surcharge on a company. So you just got to be careful. If you do start investing in a company or a trust, there is certain taxes that you have to pay, and a land tax surcharge that you have to pay in some states. So you got to check it out, and I'm not going to list it out because every state's different. The great thing about New South Wales, if you live in New South Wales, that there is a land tax free threshold for companies. And the reason why I raise this is because actually the next structure, a trust, doesn't have a land tax free threshold, which means that they get taxed severely in a family trust. The last thing is your losses get retained in a bucket company. So when you set up a company to purchase a property, it becomes a separate entity. And so it's not in your personal name anymore. The ATO doesn't see it that way. And the government doesn't see it that way. So that company itself can get sued. That company itself can pay taxes. But that company itself also, if it makes losses, can't like transfer the losses to your personal name and get negative gearing. It has to stay within the company. So the losses are carried forward. It's kind of like a disadvantage sometimes if it's a negative geared property. But if it's positive geared, then you don't need to worry too much about the losses carried forward. Okay, cool. So 25-30% is the tax rate normally for bucket companies. And the way family trust works is that it's not a separate entity. What it is just an agreement that the trustee, which is the controller of the trust, would run the assets and own the assets on behalf of the owners, which are the beneficiaries. That's how a trust is set up. Agreement has been set up. And the way a trust was started was back in the day, there used to be kings and queens, and they used to go on like these crusades, the kings. And when the crusades what would happen, it would go for many years. So the kings wouldn't be living on their lands to protect it as well as receive all the benefits. So therefore, they created a trust. A trust is basically an agreement in place that a trustee, which is a controller, would control all the assets on behalf of the kings and queens, which are the beneficiaries. And that's eventually, over time, this turned into a family trust, and then this family trust became a tax structure. So now, instead of putting all your assets in your personal name, we'll put all our assets, like the high net worth assets, into a trust that we benefit from, but it's not in our name. And it was an amazing structure back in the day for taxes, because you could distribute your profits to your kids. But the ATO has stopped that or slowed it down. So you can't really do that as much anymore. And so the result is a family trust is still amazing for distributing profit, but you got to be careful for property investment, because the government has slowed down and limited the benefits, basically. So obviously you still get your 50% discount. There still is asset protection because it's not owned in your personal name. But there are issues with Division 7A, which I'll go into more detail. There's issues with land tax. So in certain states, excluding WA and Northern Territory, there is actually a surcharge on land tax for trusts. So Victoria has a surcharge. The rates are higher. New South Wales, you don't get a threshold. So you can pay, if you have a property that's worth $1 million in land value, you could be paying $16,000 land tax per year. If you had it in your personal name, it could be exempt because it's under the threshold. But because you own it in your trust, then you'll be paying an extra $16K. Distribution of income is what I mentioned. The great thing about a family trust is if you have family members that are over 18, they're low income earners, like your partner and your adult kids, or mum and dad that don't get pension, that just don't have a high income, we could distribute the profits that you're making from the investment properties to the family members to minimize the tax and lower the tax. Because like I said, in your personal names, it's 0 to 47%. So you're making like $0, then your tax rate is going to be very low, 0 to 16%. And so therefore, it's probably one of the lowest tax rates you can get. So in other words, a family trust doesn't actually pay taxes. It's the beneficiaries and the individuals or the bucket company the money goes to from a family trust. They are the entities that pay the tax. So technically, a family trust doesn't have a tax rate. There is a penalty tax, which is the highest tax rate, 47%, if you leave the profits in the family trust. But generally, most people just pay the profits out. Last thing is that it's similar to a company. It's separate. So therefore, the losses, if you make losses in the family trust or a bucket company, the losses get trapped in that entity. The last thing is the SMSF. I won't go into too much detail because it's quite complicated. But a super fund has strong asset protection, probably stronger than all of these combined. And the reason being is because it's written in the SIS Act, which is the Superannuation Act, that states that superannuation is really for your retirement. So people can't go after it unless they have a reason why your retirement benefits them. And it's usually only partners that really have the ability to go after the assets sitting in a super fund. I wrote SMSF, but it could be super funds as well. But SMSFs are the only entities for a super fund that can purchase property on your behalf. So there are a lot of rules. So no in-house assets. And there's a lot of specific rules that you have to meet before you can buy a property. You can't buy your home in there. You can't buy a property that you're renting to a family member. So it's quite hard to purchase property that's linked to you. But you could buy, like say you're running a business, you could buy your commercial property in your SMSF because the business is separate from you personally. So therefore, it's not really considered an in-house asset. Usually these SMSFs are great for long-term growth assets that you keep for 10, 20, 30 years. You're not planning to sell. It's amazing. But if you're planning to sell short-term, you can't actually take that money back out because you have to wait till you're 60 or 65 when you've retired before you can take that money. So if you put all that money in and then you buy assets with your super fund, it's amazing. But the problem is you can't take it out if you're like under 60. So best to leave a long-term investment assets in your super fund rather than like short-term assets. Okay, best tax rates in Australia for this one. It's 15%. Sometimes even or 0% if you're over 60 and you've retired and you're on pension mode. Okay, cool. So that's basically a quick guideline of the different structures. All right, cost-wise, this is free because you're buying in your personal name. Cost meaning setup cost. And bucket company could cost you anywhere between $700 to $1,500, depends on who you're setting it up with and the types of registration you have. The family trust usually costs anywhere between $2,000 to $2,500 because you're setting up a trustee company with it. Look, I won't go into specifics. I got a lot of videos about the trustee company and what it is, but basically I would always recommend that if you're planning to set up a family trust, you should always set up a trustee company and you should not have your personal name as the trustee. It creates a bit of risk if you do have your personal name as the individual trustee because it gets rid of the asset protection that you were supposed to get. And then SMSF costs anywhere between $2,500 to about $4,000, depending if you have to go and borrow money, it's more expensive. Okay, so these are the different structures. The last thing I don't have here is finances. So remember, I mentioned to you guys, when you buy property and you're looking at the structure, it's not always about taxes. Sometimes it's about the one question that person asked at the very start, which is, I'm a mortgage broker and my question is, how should I structure the finance for clients who are wanting to buy heaps of properties over time? So you shouldn't buy property just based on tax deductions and what's best for you in the short and long term for tax minimization. You should actually buy property sometimes for your ability to structure your property purchases so you can buy more property and finance more deals in the best structure as well. So if you buy everything in your personal name, it actually limits your borrowing power. Okay, so that's a very important fact that you need to understand, that when you start buying as your first-time property investor, once you buy a property and you borrow money, say you borrow like $1 million and you buy a property for 1.5 mil, now you've got a loan of $1 million on your head. So the banks, every bank that you go to now will always see that you've got $1 million loan on your head and you need to make more income now to service that $1 million plus the new loan that you're planning to purchase. Whereas if you purchase in a bucket company or a trust, it frees up borrowing power. And it frees up borrowing power here. So what does that mean? It basically means that because that loan is in your bucket company or in a trust, as long as there's quite a fair bit of banks, even the big four banks, will just want to confirm that this company or this trust can meet its own debts, it can service its own debts, and it's profitable, then that will exclude this loan that you have in the bucket company and the family trust out of the picture when you're buying the next property. So there is a lot of talk online that says that you can get unlimited borrowing power. That's not necessarily true because you need to be able to service your loan still. But if you go to an accountant and the accountant can prove that this bucket company and this family trust service its own debts, then that loan of $1 million that's sitting in the family trust and the bucket company gets excluded out of your serviceability. And so therefore, you have your own personal income that you're making to purchase and to service the new loan. And so you can keep rinse and repeating. So you buy a property, get it positively geared, and then if they take that property loan out of the picture, and then you can use your income again to service the next property and set up another bucket company or trust to purchase. So that's why they have multiple companies and multiple trusts to help you borrow more. So to answer your question, Anna, it's usually buying in a bucket company or family trust that helps you with structuring from the very beginning. Some people would just refuse to buy any properties in their personal name. Cool. All right. So SMSFs allow that too, but the problem with SMSFs is that there are strict rules and it's costly to purchase in a SMSF. And then the second thing is you can't refinance. There's the specific rules with the banks and the super fund. You can't refinance the equity that you earn on a SMSF on one property to buy another. So it gets a bit complicated. Usually you have to pay off the loan, or you have to figure out, you have to put enough cash in there to do it, to be able to do that. So it's not actually a good move if you're trying to buy more property in the super fund. So let me just answer some questions. There is a question that says, what happens to CGT if a property is held in a trust, then distributed to a bucket company, given that individuals are already in a higher tax bracket? Okay, so it depends what type of income you're talking about. So let's say that you've got this property, you got $1 million in this, it's worth $1 million in the family trust. And my question now is, what profit are you talking about? Profit on sale of the property or profit on rental income? So the rental income, the profit on the rental income, it just gets distributed to the individuals if they're all low income earners, and it gets taxed at their tax rate, 0 to 47%, depending on what their tax rate is, right? However, they don't get a 50% discount because 50% discount is only applicable to capital gains tax, which is the sale of the property. So if you distribute the profits to rental income over to the individual or bucket company, it's just taxed at the tax rate of the bucket company and individual. If you distribute the profits of the sale of the property and its capital gains tax, if it's done to the individual, you get a 50% discount still. If it's done to the bucket company, you don't get the no 50% discount, but it gets a flat tax rate of 30%. Just that's how to answer that question. Let me know if I've answered it properly. Can you claim land tax as a deduction of your capital gain when you sell? Yes. So land tax is a state tax. If you're renting the property out, then you can claim it against your rental income, because every year you have to pay it. So you get to offset it against your rental income. If you're holding it and you don't get any rental income and you sell it, like say 5 years later, then you get to add up all the land tax you've paid. But I'm just telling you, like, land tax is massive for people who purchase property in New South Wales. So isn't there a land tax free threshold for investment property in New South Wales? Yeah, that's a good question. So land tax free thresholds are applicable and given to individuals, companies in New South Wales, but in so land tax for New South Wales trust. So special trusts don't have the threshold. So it says special trusts are taxed at a flat rate of 1.6% amounts up to the premium land tax threshold. And so therefore, a special trust does not receive the land tax threshold. And this is the crazy thing. So if you purchase a property in your family trust, and it was like the land value was, say you bought it for $1 million in New South Wales, but the land value was 600K. In New South Wales, and this is only in New South Wales, yeah? So different states have different rules. But in New South Wales, if you purchase that 600K land value property in your personal name, it's under the threshold. So more than 1.07 mil, you'll pay 1.6%, right? If it's over that. So every dollar over this amount here, you'll pay 1.6% of that value. But because it's 600K, in your personal name, you don't pay any taxes. So you don't pay any land tax if you purchase it in your personal name because the land value is under $1 million. However, if you purchase it in the family trust, that 600K, the threshold that you normally would have got gets ignored, and you just pay land tax straight on that amount. So if that amount, say, is 600K, then you'll just pay that roughly 9,000 every single year because you purchased it in a trust. So sure, it's great for capital gains discount. You get this discount now, but then you lose the best benefit, which is you get the discount, but then you lose on land tax because you end up paying a massive surcharge every single year as a result of that. So be very careful when your advisor tells you to buy under a family trust. Okay, so I'm going to just quickly, there's a lot of questions, so I'm going to quickly go through the questions. Can monies be retained in a family trust or must be paid distributed? Monies can be retained, but you get a penalty tax in a family trust of 47%. So there's a penalty tax, you can retain it. Most people don't do it. So that's why only really, really rich people that already have everyone on 47% already, and they don't want to be distributing any profits to their kids. So like rich generational wealth, that's passed down from generation. There's like a trust that owns like so much business or property or shares, that's when like profit gets just retained at paid at 47%. But generally, most normal people don't leave the profits in the trust. They always pay it out to an individual or something like this, because you can actually use a mixture of both. So this is one trick that we do, is that if you're planning to, and you have a lot of investments, we might use a hybrid version of this, which is we have the family trust own the bucket company, and we use all this structure here, where the bucket company gives you 30% tax, and you own the property in here. But then if you ever want to pass the profits out of the bucket company, because you've got retained profits sitting here every year, and you want to give it to the family, and the family passes it over to the individuals, then you have the family trust own the bucket company, and then keep the retained profits in at 30%. When you want to take the money out, you pay it out to the family trust, and then it distributes to the individuals. That's what we do. So we don't need to retain the profits sitting at the family trust, and it ends up being paid 47%. And we don't need to pay it out every single year because the tax rates might be high. So we can keep all the profits sitting in the bucket company. So that's the beauty of having both bucket company and a family trust. Downfall of that is it's expensive to set up, and you got to set it up from the start. You can't like transfer it in later, because then it causes something called stamp duty when you invest, when you're transferring property. Okay, so quickly just trying to answer most of these questions. Is there any use of family trust if you are just individual with no family at all? That's a very good question. And the answer is yes, there is still good use. Okay, so why? It's because you, my friend, might be a high income earner, and you might be generating $300,000 in your personal name, right? So you don't really want the profit to go to your personal name. So you might want a family trust or a bucket company to be able to purchase the assets with. And remember what we mentioned before, not buying in your personal name and buying in a bucket company and trust frees up borrowing power. So remember, like, it's not just for tax purposes. Buying in a bucket company or family trust is beneficial, because you sometimes want to buy in a bucket company or a family trust just to free up the borrowing power so you can buy more. If you don't know what I mean by the borrowing power things, go check out my deep dive about financing, and you'll understand how the calculation works, how the banks calculate, just a general idea of how they work out how to lend you money. And they usually lend about 6 times your income. So if your income is, say 300K, and they lend you about 6 times this, and they lend you 1.8 mil, your cap is 1.8 mil. So if you only can borrow 1.8 mil in your personal name. So if you buy like, say $3 million worth of assets, and you borrow 1.8 mil, you're at your cap. You can't buy a second property, of a third or fourth property. But if you move that asset into a family trust or a bucket company, now that 1.8 mil might be here, and you still have that 300K income to service the next property you buy, because you've got an accountant's letter that states that this family trust and this bucket company service its own debts, and that's possible. Yes, there's an argument that as long as your income keeps increasing, then you don't have any issues, or if your income if your investment properties are serving as debts, then technically in your personal name, it should be able to service that as well. Yes, that's right. But then there are ways to write this letter, to get this accountant's letter to say it's profitable, but also be able to take that money and use it for your next purchase as well from the bucket companies and family trust. The family trust and bucket companies can be linked to the next trust. So there are ways to like maneuver around the loopholes of freeing up borrowing power. If you're not sure about this, speak to your accountant or your broker, and they can have a better explanation on this. I'm not a broker, so I'm not very good with explaining how the borrowing power works. But yes, there is a benefit of using a trust or even a bucket company to purchase, even though you're an individual without any family members. And also on top of that, having a family trust to distribute to a bucket company at 30% tax rates is useful as well. So, but yeah, you're probably leaning towards bucket company and personal name for your situation, because you might not have any individuals to distribute to. Okay, so I'm a buyer's agent, and a lot of clients come to me for advice whether to buy through individual's name or trust, best to direct them to an accountant and mortgage broker. Yeah, I think it's best for you not to answer that question because it really depends. Can I quickly show you guys a questions to ask? That could help you out. So a lot of you guys are advisors. So you're a broker or a buyer's agent. These are the questions that I would generally ask my client. So what are your intentions of the property? Are you buying an investment property for cash flow generating, or is it positively geared? Or is it negatively geared? Is it growth in value of or a price of property? So are you aiming for the growth in the value of the property, or are you aiming for negative gearing? Because if you're aiming for negative gearing, then buy in your personal name because it's negative geared, it will offset your high income that you're earning. If it's cash flow generating, then buy in a bucket company or a trust so you can distribute the profits to a bucket company or to individuals that are low income earners. If you're buying for growth, then a bucket company may not be the best idea because you don't get the 50% discount. So a super fund or a trust or your personal name might be the best bet so you get the 50% discount. And then the question then goes like, what is your long-term and short-term investment? Are you planning to sell the property within 5 years? If so, then you need to, if you're planning to keep it forever, could a super fund be the best idea because it's got the lowest tax rate? Property development. Are you planning to develop the property? Is it going to be your home? If it's your home, you can pretty much throw everything out the door and just buy in your personal name because it's your home. Because you want to claim the main residence exemption, and you also want it to be exempt from land tax, and you only can do that if it's your home. How would the deposit and the funding of the actual property investment work? Okay, so this is a question that never gets asked. And I asked this question because I think it's very important. So my question basically is, when you purchase this investment property, where are you getting the funds to get that deposit to buy it? So when you buy $1 million property, say it's $1 million, you need to usually put down a deposit. And that deposit would be, say, 20% maybe. And if that deposit's 20%, maybe sometimes 30, 40 if it's a commercial property, so you need to put it down to 20% deposit, say, you need to get 200K to put down as a deposit, and you need to pay tax on that 200K. So where did you get it from? So if you got the money from your company or your profits, it creates something called Division 7A. So this is where I'm going to go back to here, where I mentioned here before that a lot of people don't talk about, which is Division 7A issues. So when you take that money out of your business, if you're this is only for business owners. So if you're a PAYG high income earner, then Division 7A would never impact you. But the way Division 7A works is basically that you've got this company or this business that's making a lot of profit, and you want to take the profit out, extract it out. If you extract it out, you're paying 47% most likely in your personal name to take that money out, because the company tax rate is 25 and your personal tax rate is 47. So when you take that money out or you borrow it from the company, the ATO thinks that you're trying to avoid taxes and they want to tax that amount that you've taken out. So it creates something called Division 7A loans and issues. So that the ATO wants to tax that 47%. So my argument is that if you're trying to find that 20% from your company and your business, you're going to realize that once you take the 200K out, you're going to be left with a 47% tax in your personal name for that 200K. Yeah, sure, the company's already paid 25% on the tax for that 200K deposit because the company tax rate is 25. But then once you put it in your personal name to purchase the asset, you're going to have to pay the top-up tax of 25% or 27%. So 22%. 22 is 47 minus 25. Yeah, so you gotta, so no one ever takes into account Division 7A when you take the money out to put down for a deposit. But if you were to lend that money to a company and bucket companies don't have Division 7A issues. And that's why for business owners, sometimes if you're taking money from your retained profits from a business and putting it into the next investment property, you might rather put it in a bucket company because you get 30% tax and you don't have to pay a top-up tax and you don't have Division 7A issues. If you're not really sure about that, let me know and I'll try to explain that a bit more in more detail. But yeah, that's how Division 7A works. And it's actually, sometimes I would advise clients to buy in a bucket company rather than a family trust or an individual name because of the fact that they're taking their money from the business for the deposit. Okay, if you're refiring, you're taking from your equity and your personal loan, the taxes, there's no tax on borrowing money from the banks, so therefore you don't need to worry about it. So I find the trust that an individual might be better for your situation. If you're taking from your wages or personal savings, taxes already been paid. You don't need to worry about paying taxes on that 20% deposit. The main thing is this issue here, where if it's from your business or your company, then you would have to pay tax on that money before you take it out. And what I'm thinking is, how do I minimize that amount? And the only way to minimize it is possibly keeping it at the same tax rate as a company. So letting it to another bucket company. So that's one question that you need to ask yourself or ask your clients. And there's a whole bunch of other questions. What is your current income? Is your income high now? If it's high, then you might not want to put it in your personal name. You might want to put it in a trust or a company. If you don't have kids, you don't have, family members to distribute the profits to, then that's something that you need to ask yourself too. So do you have family members and beneficiaries? Because there's sometimes not a point of setting up a trust because you don't have family members. But trust is still useful sometimes because you can distribute to a bucket company instead. All right, so another question you would ask is, are you looking to purchase more? And so therefore borrowing power is important. So that if you're looking to purchase more in the future, then setting up a family trust and a bucket company allows you to borrow more later on down the track. Do you have investment properties and are you maxed out in land tax? So there are land tax rules and the thresholds. So sometimes you want to buy in your personal name first because you want to, if you're buying in New South Wales, for example, you might sometimes want to buy in your personal name first. And the reason being is because you want to claim the land tax free threshold, because you currently have a land tax free threshold of up to 1.075 mil. So you might want to buy in your personal name just to make sure that you don't have to pay land tax. And then the next property that you buy, you might buy in a trust or a company. So you can, because you can avoid land tax. So that's a question to always ask about land tax. It's usually for only seasoned investors, investors that already have multiple properties, that they want to max out their threshold on land tax. Because land tax is a big deal if you own property that's valued at a very high land value. One big question for you is, if you operate in the industry or a business that is very high risk, you may not want to buy anything in your personal name because people will go after you. So for example, if you're a builder, a lot of builders don't generally like to have property in their personal name, because if they have one bad deal where they build a property and it gets there's defects, they can lose their license, they can get sued for millions of dollars, and then basically they'll go after him and his personal assets. So therefore, if you've got your home, your investment properties all in your personal name, the 10 years of you building your business and your wealth could all go to waste after you do a bad deal. So that's why my recommendation, depending on your industry and what you go through, what you work in, and also how risk averse you are, you may not want anything in your personal name. Just even though you are like single and don't have any family members and don't have anyone to distribute to, you may still want to keep everything away from your personal name so you don't lose everything. So it's important to even look at that, not just for tax purposes, not for borrowing purposes, but also just risk averse and protecting your assets. Last thing, I have to always ask this question, and I'm not a lawyer, but I just generally ask anyway. Do you want to protect your investment property from your future partner or ex-partner? So that's actually a common question, that common thing that people do. Some people have some people have ex-partners that are very feisty, very negative, and they just don't want them like trying to go after everything because they've been through a divorce already. They lost like pretty much all their assets, and they just want to make sure that that person doesn't go after anything else. Yeah, so It's a common question, and if that's the case, then you don't even need to worry about the taxes. You'll most likely buy it in a family trust or a bucket company that's separated from you or your super fund. Cool. All right, going back to questions. Does it make sense to create a trust if you don't have kids over 18? And yeah, so I answered that question. Basically, it still makes sense depending on your tax rate, depending if you want to protect yourself, and depending on borrowing power. So if you want to borrow more and buy more in the future, then some people set it up straight away. I actually have one of our clients that I advised them that you could buy in your personal name because you don't really have any investment properties. And he's like, no, I want to buy straight away in a bucket company or a family trust from the very start because I know that I want to buy more in the future. And if I buy it all in my personal name, it will limit my borrowing power later on down the track. So I just want to start the process of buying in trusting companies from the very start. And also, I know one day the property will go positively geared and I want a flat tax rate of 30%. Rather than in my personal name where I'm a high income earner because I earn $250K a year and paying 47% tax. So they rather just buy the property in the bucket company instead. So cool. If you only pay accumulated land tax when you sell, okay, so land tax is not when you sell. It's basically every single year. So that's the problem with land tax. That people think that they only pay when they sell, but it's actually per year. It's just that the OSR or Service New South Wales or all the different other states, they're very slow to calculate and assess the land tax. So they only assess it when you transfer the property away, and they hit you for the last 5 years that you own the property. So you're actually supposed to tell the government that, hey, I own this piece of land and I need to pay land tax every single year. And it usually gets levied on the 31st of December. And you have 2-3 months to pay for it. But the problem is not many people do it properly. Yeah, so speak to your accountant if you haven't been paying land tax and you own multiple properties. You're supposed to pay it every single year. If your client is PAYG, would it be still beneficial to purchase a property in a company or trust because they can only use it for rent they could only use the rent for income servicing? It's the same question before, which is basically, it depends on these questions here that I showed you guys. So how high is their income in their personal name? Is the property negative geared? Or is it positively geared? If it's positively geared and they have a high income in their personal name, then maybe buying in a bucket company is better because the tax rate's lower. It's at 30% and their personal name is 47%. If they're not planning to sell anytime soon and they want to refinance, then a bucket company might be a better idea because they're going to buy multiple properties and eventually it's all going to be positively geared and they're going to just live off the bucket company profits, cash flow generating properties, and then just take a dividend every single year. There's this if I can split and explain something real quickly. My personal goal in life is to have, and let me just play around with this, is an individual, my personal name, generating all this income, and then have an SMS, and then release my assets in an SMSF, invest my assets in an SMSF in a bucket company. What's going to happen is one day I'm going to have my goal is 5 mil in net assets here, and then a super fund, say, anywhere between 2 to 3 mil. Okay, this is obviously I'm not even close, but I just want to point out this is what my goal is. And then I want to have $1 to $3 million in net assets in my personal name. That's my home, whatever it is. So altogether, it's about $10 million right now in this situation. I don't know if the goalpost is going to change, but that's what I want. Okay, so right now I'm 35, and from the days of 40 all the way to 60, what's going to happen is, from the days of 35 to 40, what I'm going to try to do is I'm going to have a cash flow generating business, obviously on the side, which is a trading company. And you don't need a trading company. I just have one. A trading company generating cash flow. So generating cash flow. And I just want to quickly show you guys this. This is a bit not just about property, but I just want to show you what my goals in life is. So I want to generate cash flow through this trading company. It could be through the company or through my personal name. And I just generate all this cash flow to be able to invest in my personal name of 1 to 3 mil. and then invest in my bucket company up to about 5 mil, and then invest in my SMSF up to about 2 to 3 mil. So I'm going to slowly release all the cash flow I'm getting into the bucket company and SMSF. And the reason being is because the tax rate here is 0 to 15%. It's the lowest tax rate in a super fund. But I can't take that money until I'm 60 plus. So I don't want to put all my assets in here. It's only for my long-term investment goals. But once I turn 60, the money I get to release out of here, and I've got like say $3 million when I turn 60, I get to take every year for the next 20 years after 60, about 150K a year tax-free. So I can live off that between me and my partner. But on top of that, from the time I'm like, and this is 60 plus years old. But here, from 40 to 60, and this is just rough numbers. I might be still working like a lot at that time, but 40 to 60 years old, I want my medium term investments here, where for 40 to 60, I'll just try to accumulate as much profit, retain profits in here and then invest it. And over time, that $5 million that I have here, sorry, that's a bit too extra zeros, the tax has already been paid on this property, on all the property or all the investments that I have in there. And that tax would be $5 million. 5 million times 30%, 1.5 mil. That's called franked dividends, franked credit, fully franked dividends. So when I ever want to retire when I'm 40 to 60, what I would just do is pay myself a dividend of that 5 mil. This is retained profits. Yeah, the company has already paid taxes of 30%. So if I ever want to take money out of this company now on the income it earns, so if I earn income on this on like say 5% per year, so let's just say that, no, not even 5%, say it's 3%. 3% of rental yield, say it's all investment properties, all residential property, I'm going to be making 150K a year. I've got frank dividends or frank credits of 1.5 mil. I can just, from that 150K I take out every single year now because it's like cash flow generating bucket company now, which makes me 150K, the loans are paid off, I now just get rental yield of 150K. I've got a tax credit that I've paid for the last 5 to 10 years of 1.5 mil. So every dollar I take out now, there's 30% tax on it that has already been paid. What does that do? It's kind of like wages, like that you pay to yourself and you get a tax credit of PAYG, tax withholding. Franking credit is the same thing. It goes to my personal name. I could take the 150K per year and I would get 30% of that already in tax credit. So I already paid my taxes for that. And if I like slap that into my wages and I stop working full time, and maybe I just stop working overall, I would have already have a credit of $30,000. So I only pay $10,000 on top. Yeah. So why do you need a bucket company? Why can't you just have the trading company? Okay, so trading company is my business. So if I invest everything in my business and it gets sued, what happens? Like someone sues Box Advisory Services, I could lose all my assets. So that's why you have to separate the bucket company and the trading company. Yeah, so that's like my ultimate goal, to have a bucket company, SMSF. They all invest. Long-term goals are 60 plus. I would start taking money here. But from when I'm 40 to 60, if I ever choose to just like take it easy, not work anymore and not have this cash flow generating business, or I sell it one day, I'll just sell it, pay off. I'm not going to sell Box, but I'm just saying if I do, I'll pay off all my loans in my bucket company and I'll just generate rental yield every single year now and just take get back my credit. So it's actually not that bad to have a bucket company. A lot of business owners think that accountants think that buying in a property, you lose the 50% discount and it's all gone. No, what you do is you just don't sell your properties and you just keep them for cash flow generating. And if you do sell, pay off all your loans and then invest it in cash flow generating assets that can net you a higher rental yield or investment yield. So say that it gives you like, if you invest in commercial assets, commercial property, it gives you a higher rental yield. So now I'm making 300K, but then the tax I paid for the last 10 years, 5 years of 30%, I can get that back when I pay it to myself as a dividend from the bucket company to me, because I will get a credit for it now. So I can utilize that credit. It's not gone. I'm just delayed my taxes that and just paid 30%, and then I get to claim that 30% back and just pay a top-up tax instead when I take that money out to spend for my retirement. And by that time, I might not need 150K or 300K a year. I might just decide to take 100K every single year. And because I already have got income in my personal name or savings, if I take 100K, the tax is 22,000, and 100K, 30% tax credit, I'm actually going to get a refund every single year. So it's just like the way you play around with your numbers to get the tax credit back. So that's my ultimate goal. And it's just something that a lot of people don't understand if they don't have a good accountant. But yeah, something to think about. Okay, cool. Now, let me quickly, I'm a bit over time. I just want to quickly answer some of these questions before I forget. Okay, so if you move a property from individual ownership to a company or trust, won't it also trigger CGT? Yes, 100% it will. That's why you got to set up the structure right properly. So I did transfer my commercial property into a SMSF, and I did incur CGT, but there are discounts, there are concessions that you can get to minimize the tax. I actually managed to get that tax to zero. So you generally want to make sure that when you do think about buying a property, you got to look at the long-term goal, what you want to do with that property. That's why it's better sometimes to buy in a bucket company family trust from the very start. But if you think that you can like transfer the property into a super fund and pay like little to no capital gains tax or stamp duty, like double stamp duty, then sometimes it's better to buy in your personal name that gives you the concession to be able to do that. Okay, so for commercial properties that you own and you use for your business, sometimes it's best to buy in your personal name for the time being because your super fund can't afford it, but eventually you maybe transfer over to super fund. For just normal investment properties, yeah, generally don't buy in your personal name for the very start. Like look at the structure and what the future goals are and then buy. If I sell a property from personal ownership to trust, do I need to sell at market rate? Yes, the answer is yes. So there's a tax ruling that says that you have to sell it at market rate. So you got to get a valuation on it, and you had to pay stamp duty at the market price, and you also had to pay CGT on the market price. There are exceptions, which is, for example, if you're selling your home to a trust because you get a capital gains exemption, and if you're getting a divorce, I think there's like a way to get stamp duty exempt. But yeah, most of the time you have to pay the taxes if it's an investment property. Are there Div 7A implications if you use your company retained profits as a deposit to purchase an investment property in SMSF? There is no Div 7A issues, but there are contribution issues. So like you can't put in $500,000 into a super fund just like that. You need to meet the rules. So there are concessional contributions, and then there's a non-concessional contribution caps. So there's like $30,000 you can put every single year. There's also 100K that you can put in for non-concessional. So you just got to run your numbers to see how much you're putting in, and just make sure you don't go over the cap. Because if you go over the cap, then you get taxed, a penalty tax on it. But most of the cases, you're probably only putting 50 to 100K in, and you won't go over it because you've got unused cap from the last 5 years. I own a home with my husband. If we want to buy a new primary residence, rent out our current house, should we put that house in a company or a trust? We also have a company and a trust together that we have just started with a new business. So transferring your property to your existing property into a trust or a company may not be the best idea due to the stamp duty that you have to pay, because you're not really getting much benefit by transferring it out. So you might get some sort of tax benefits in the future, but then you have to get hit with double stamp duty. And stamp duty is like 3 to 5% of your land value. So if your property is worth quite a lot, it may not be worth to transfer it out. It might be just worth rent it out. It might be already negative geared anyway because you've got a loan on it. So it won't affect you too much in the short run in terms of like your taxes. So transferring it out, you might not get that much benefits putting it in a trust or company. So you might as well just leave it in your personal name, so you don't have to cop this double stamp duty by transferring it out. But I don't know your full situation, so it's very hard to answer this question. So it's best to get the full picture, ask the right questions, answer the right questions, which is these questions here, and then understand what is it? Is it cash flow generating, negative gearing? Is it going to go up in more in value? But so that's the things you need to look out for. If in your goal, does a family trust own the business and bucket company? Oh yes, yeah. So I have. Yes, that's correct. The answer is yes. Yeah, so sorry, I'll just quickly go back into this structure here. Yeah, so my bucket company and my bucket company is owned by a family trust. I won't tell you which one, so you can't go after it. But yes, so I have a family trust that owns the bucket companies as well as the trading company. So my business is owned by a family trust and my bucket company is owned by a family trust. Why do we have that? It's because I want the flexibility to be there in every single year, decide where the profits go. So I'm very family orientated, and I've realized that I don't actually want to be buying assets for entertainment, but I want to buy assets for my family. So I've been actually distributing my profits to my family members. So family members being my brothers and my mum and dad. So I actually split my profits between my families. So that's my goal as well, because I know that eventually I'll get to that goal of having 5 mil in my bucket company and SMSF of 3 mil. It's just when would I get there? So I could get there faster if I just take all the profits and do it myself. But I've decided that I want to help my family. So having a family trust sit right at the top and then give me the flexibility to give money to my parents and to my brothers, as well as my bucket company over time. And then once the bucket company has enough retained profits and rental yield or cash flow to take that money out, I'll take it back out, put it back into the family trust, and the family trust distributes it to all my family members. So that's why having a family trust is really important, Mandy, at the top to distribute.
Just a question on that. Is it 2 different family trusts or just the one?
Oh, that's a very good question. It depends on you. So I would have 2 different, because you want the family trust, one family trust just to deal with your business income, and you want another family trust just to deal with your property investments. Keep it all separate if you want full protection. Yeah, but it's up to you. Just depends on how big your businesses are and how risky your business is, or you can technically just have one family trust do everything. Sometimes you just want it separate because the business income gets split with your family, and then your investment and your bucket company gets only split with your immediate family. So your husband, wife, and kids, but then mom and dad is separate. Yeah. Cool. Can I set up a bucket company later? Yes, bucket company can be done later. It doesn't have to be done straight away. But understand that if you're buying the property, you might need to set it up at that time. So if you can't just move it in there because it will cause stamp duty and capital gains tax. So once you're buying a property, you have to set up the bucket company, but you don't have to set it up now and then just wait for the next 5 years until you buy the property. You set it up 2 weeks or 3 weeks before the property is purchased. Does a property in SMSF protect borrowing power capacity? Yes, but like I said, it shouldn't be. It does protect your borrowing power. But you only get my understanding is you only get it once, like a one-time. It's like a get out of jail card once, because once you purchase it, it gets locked on that property, and you can't actually even refinance the equity out of that SMSF to buy another property, because you can't take the money out from the SMSF. And also on top of that, there's these rules that stop you from refinancing the equity to purchase another property in the SMSF. So it's like one get out of jail free card, and you use it once, and it does unlock borrowing power in your personal name, because you can still buy in your personal name, and the loan gets trapped in the SMSF, but you only get to use it once. What's the best structure to use when inherit a property? It's so hard to answer that, because it depends on the property value, what your plans are, your intentions. Are you going to live in it? Because if you're living in it in your personal name, just put it straight to your personal name. If it's cash flow generating, makes a crap load of rental income for you, and it's completely paid off, and you're going to just let it sit there, bucket company, because 30% tax, you get get that 30% tax credit. You can pay it out to yourself if you need it. Or family trust, if you've got family members that are low income earners, and you can distribute the profits, but you don't want it in their name because you want to protect it yourself as well. So it really depends on your situation. Super fund maybe even is a good idea too, if you have enough money in your super fund to transfer it in, to buy it. Yeah, I think I've answered all the questions. Appreciate it, and thank you. See you guys later.